Inventory valuation by using the average method. Let's assume that the business bought 5 units at $10 each in the first purchase. In the second purchase, it purchased another 5 units for $12 each. The business sold 3 units. What is the cost of the units sold? Since the business is using the average inventory method, we need to calculate the average cost per unit. The total units purchased are 10 units for $110. The average cost per unit is equal to the cost of the goods available for sale divided by the number of units available for sale. So it is equal to $110 divided by 10 units. This equals $11, and the value of the 3 units sold will be 3 units times $11, which is $33. So what is left in inventory? 7 units valued at $11 each, so the ending inventory's value is 7 units times $11, which is equal to $77. Let's assume that the business sold another 3 units. How are we going to cost them? Since no new purchases with a different price are done, the average cost is still the same at $11 per unit. So the new units sold are still valued at $33 and total cost of goods sold is $66. The inventory has 4 units valued at $11, so the ending inventory cost is $44. Let's now take an example to apply this costing method on both periodic and perpetual system. A business has beginning balance of 5 units for $10 each. Accordingly, the period started with 5 units. In the periodic system, we just record the units at the beginning of the period and the units purchased. We do not keep a record of the units sold. On May 10, it purchased 10 units for $15. On September 28th, it purchased another 10 units for $20. The business took a physical count and found that there are only 7 units left in the warehouse. Here is a summary. The business has beginning inventory of 5 units for $10 each. On May 10th, it purchased 10 units for $15 each. On August 14th, it sold 11 units. On September 28th, it purchased another 10 units for $20 each. On November 5, it sold 7 units and didn't do any further transactions regarding this product till the end of the period on December 31st. Let's calculate the goods available for sale to derive the goods sold. The goods available for sale is equal to the beginning inventory plus purchases. In our example, the beginning inventory is worth $50. The first purchase is $150 and the second purchase is $200. The total number of units available for sale is 25 units and their value is $400. Since the ending inventory is 7 units, we can derive the goods sold by subtracting the ending inventory from the goods available for sale. It is equal to 25 units minus 7 units, which is equal to 18 units. So the business sold 18 units. Since we are using the average method, we calculate the weighted average cost per unit. It is calculated by dividing the value of the goods available for sale by the number of units available for sale. The value of the goods available for sale is equal to $400 divided by the number of units available for sale, which is 25 units. So the weighted average cost per unit is equal to $16. Accordingly, the ending inventory is equal to 7 units times 16, which is $112. The cost of goods sold is 18 units by $16, which is $288. Let's now see how are we going to cost the goods using the perpetual system. In a perpetual system, we keep record of all the flow of goods, whether buying or selling. Each single inventory item has a page in the inventory subsidiary ledger. So we started the period with a beginning balance of 5 units, each costing $10, so this will give us a balance with a total of $50. On May 10th, there is a purchase of 10 units for $15 each. Such information is recorded under the Purchases section as follows. The total value is $150. This is the multiplication of the number of units by the units cost. Now, the balance is composed of 15 units, the 5 units from the beginning inventory, and the newly purchased 10 units. The value of this balance is $200. That is $50 from the beginning inventory plus the $150 paid for the purchase. The average cost per unit is equal to the value divided by the number of units. So it is equal to $200 divided by 15 units, which equals $13.33. On August 14th, the business sold 11 units. This is recorded under the sold section. Notice that we're using the average method. So we're using the average cost per unit that we last calculated, which is $13.33. So the cost of the 11 units is 11 multiplied by 13.33, which is $146.67. This leaves a balance of 4 units multiplied by $13.33, which gives us a value of $53.33. On September 28th, the business purchased another 10 units for $20 each. Since the purchasing price is different than the current average cost per unit, we have to calculate a new average. Again, the weighted average cost per unit is equal to total value divided by the total number of units. The total value is $253.33 divided by 14 units, which is 4 units plus 10 units. So the weighted average is equal to $18.1. On November 5th, the business sold 7 units. Using the average method, we write under the sold section that 7 units are multiplied by the last calculated average of $18.1, resulting in $126.67. Ending inventory is also 7 units, which is the result of subtracting 14 units minus the 7 units sold. So the value of the ending inventory is 7 units multiplied by $18.1 to be equal to $126.67. At the end of the period, the cost of goods sold is calculated by adding all of the value column under the sold section, which is equal to $273.33. The ending inventory represents the last figure in the balance section, so it is equal to $126.67. Notice that the cost of goods sold and the cost of ending inventory are different in the periodic system than in the perpetual system. The periodic system uses the weighted average, whereas the periodic system uses the moving average. With the moving average, the units sold are affected by the most recent average cost per unit as previously illustrated.